Hello, everybody, and welcome to the Know Your Shit podcast, where our knowledge and pride drives us to be excellent. My name is Josh Cadillac, and I'm in the driver's seat once again as we learn how to stop just doing deals and learn how to start building a business that we can be proud of. We do this by talking to some of the successful people in business to see how they achieve success so that we can do something, we can build something here and be successful as entrepreneurs. We have a great show for you today because we have a great guest, Mr. Brady Mullen. Brady, thank you so much for being with us.
Yeah, thanks, Josh. I appreciate it.
So, Brady, let's start off the way I love to start off. Why don't you tell everybody what it is you do?
It's hard. I can't put it in a word because I don't know anybody else that really does what I do. I work for Cross Country Mortgage, but my title is in business development, which I've learned is what you call people when you don't know what to call them. But my background, I was a financial advisor for 19 years, sold my practice. I had a partner and, we sold it profitably. It was great. It was a good business for me. But one of the reasons that I sold it is I became really passionate about how real estate plays a role in people's finances. And it plays a role in everybody's finances, by the way. There's nobody that can escape that because you need shelter, right? And so when people think, well, I don't have real estate, it's like, well, yeah, but you're not sleeping outside.
Yeah. You're somebody else's real estate act.
Yeah, your $2,500 a month rent is not a non-financial decision. That's a big financial decision.
Yeah.
Right.
No, I think that's huge, man. That idea that not making a decision is making a decision. You know, you're participating in one way or the other. The question is, which side of the equation are you going to be on? My father used to say it to me this way. I'd go to, I don't know how old you are, but when I was a kid, I'd go to the mall and they used to have these magical places called arcades. You go to the arcade and you exchange like real money for their money, and then you could put their money back in the machines. And my father was definitely older when I came around. He said, son, you don't want to be the guy putting the money in the machine. You want to be the guy taking the money out of the machine. And that's very much how I feel that rent conversation has. And the other note I had from what you said was in medicine, I learned this because my father was older. As he got older, you start to get aches and pains, and when they don't know what to call it, they called it fibromyalgia, which is like the catch-all. So basically, that's what you're saying. Your job is you are the fibromyalgia. You don't know what to call you, so there you go. You can put that on your business card if you want.
The fibromyalgia. Yep, I love it.
They don't know what to call me, so they're calling me this.
Yeah.
What got you started with that, Brady?
Well, frankly, I'm a father, and my oldest child is now 25. And I remember thinking, what can I help my kids with? I don't know everything, and I'm not a perfect dad or a perfect guy, but I know something about finance, and finance is something that everybody's interested in. Now, you might not be interested in how it works. You might not be interested in spreadsheets. There's lots of people that don't dig that kind of thinking, but nobody's uninterested in finance because it's the lifeblood of the economy and you have to have it. So everybody's got an interest in that. And so financial pressure sucks. It's real. And when you experience it, you know that it's not nothing. And so I thought, how can I help my kids? And there's one thing that trumps everything, which is learn how to spend less than you make.
Yeah.
But the very next step, I couldn't think of anything more powerful than don't pay a landlord any longer than you have to. And there's a lot of misinformation about that out there. You see these online, these influencers, and some of these are big names, people that have 1 million, 2 million followers that are saying that home ownership is a bad financial idea. And we live in a culture where, if you're not licensed, you can say whatever you want. But if you are licensed, you have to be careful about what you say. And so you get these people that aren't licensed. They're nobody's fiduciaries. They're just good at making interesting videos and channels. And then they tell people really bad things that all financial professionals know is incorrect, but they can't talk about it for compliance reasons very clearly. So we got it. There are people talking about, in fact, I just had this conversation the other day where somebody was like, yeah, but I like renting because all the money that I would pour into home ownership, I can put into the market and I'll get a better return there. And I'm thinking to myself, I'm trying to be congenial with people that I'm talking to, but inside I'm screaming because I'm thinking you can't put the money that you're going to spend on your house into the market because you have to give it to the landlord because you can't go without shelter.
Absolutely.
You're not going to have a bunch of bums sitting around a fire, in a barrel in the street under the bridge talking about their stock portfolio because they put all the money that they were going to spend on shelter into the stock market. You can't do that. You need shelter. So it's got to go one place or the other, and you're going to spend millions of dollars on it over your lifetime. So who's going to own the assets when you're done?
Absolutely. I think, and I've had this conversation many times. The offset, because what they're going to hit you with then is the differential between what the rent is and what the actual cost of home ownership, which is principal, interest, taxes, and insurance, which right now, because of interest rates being where they are in a lot of markets, that payment is higher. But the thing is, that payment is relatively fixed. At least the principal and interest portion of that payment is largely fixed if you're in a fixed interest rate mortgage, right? So all you're really looking at is the differential between what the home payment would be. And that's the only investable quotient. And this implies that you have perfect financial discipline, which if you meet an American that's got perfect financial discipline, please send them my way because we're looking for unicorns over here. And I haven't found any in a while, right? So, like, nobody's got that kind of personal financial discipline. And here's the thing: what the hell do you think your rent's going to be 5 years from now?
Oh, yeah. If you look at it over a lifetime, you might be thinking, well, it costs more to own than to rent. And that's only if you put 5% down or 10% down. If you put 20, that's going to be about equal. But even still, you add that up over your lifetime and your rent might be smaller for 3 or 4 or 5 years, but your home ownership costs are going to be less for many, many decades, like to the tune of millions of dollars.
And then the time value of the money, the compounded growth of the real estate is really the secret sauce because it is.
Oh, yeah.
What's beautiful about it is tax deferred growth. And if it's your primary residence, it potentially is tax free growth. And this is the piece. This is the component of it that, I see those guys and I get so grumpy. I'm not going to lie.
I can't even imagine that.
Asked me to take and make a response video, and I'm like super excited to record it because I'm like, it's tough even for Instagram. I'm sure this level of stupidity must strain the servers when people say stuff like this, like it's so bad. And it doesn't take much. I mean, if you just compound that real estate forward at even 3%, which is underperforming what the market has been for quite some period of time because of the shortfall in housing. We're so behind as builders that the appreciation has actually been outpacing that. If you carry that forward for 10 years, you have this huge cushion in the accumulated wealth to offset any differential there is between the rent and home price payment. It's confounding.
That's an interesting idea because some of the things that you're saying, I'm hearing the arguments that a lot of people who disagree with that are saying, and they're saying things like, yeah, but you're not throwing into their tax and insurance and maintenance and stuff like that. And it's like, hold on a second. A, yes, I am. And B, if you don't think those things are included in what the landlords charge for rent, you're insane. Of course they are. Now, they might pay the bill when it comes up, but if you don't think they're amortizing that into the cost of rent, you're incorrect. They're running a business, and whatever their costs are, they're charging that to the tenant and then some for their profits. And there's nothing wrong with that. Like it's okay to rent. I've rented in my life. It's better to have shelter than not have shelter. But a long-term strategy, it just doesn't make sense. And when people talk about like, well, if I put the money in the market, it might appreciate at 10% or 12% or something. But if I put it into real estate, it's appreciating at 3%. And it's like, well, you're not accounting for the leverage, and you're not accounting for the fact that you don't have to pay a landlord thousands of dollars a month for the rest of your life. Like when you put all that stuff together, which is the book that I wrote with my brother, we were talking about that before we got on air, but is about home ownership. And we take all these calculations into consideration and say, here's what's happening with the money for the landlord. Here's what's happening for you. And again, it's not a sin to rent, but when you look at it long term, you're in the hole millions of dollars compared to buying something similar, even with the cost of maintenance and taxes and insurance, all that's being paid anyways. Absolutely. Of course you're paying for it.
Absolutely. No, I mean, people just, it's such bad financial planning. But let me ask you this. What do you like best about this role, this difficult to define role that you have?
That's a good question. So what I was doing immediately after I sold my practice is I was working in real estate, trying to help people understand these features or these characteristics of their real estate decisions. And I realized that I could help more people if I went in and started, frankly, as a lender. Although I teamed up with lenders and I tried to fill the pipeline to help give realtors things that they could talk about, and created content, videos, wrote some books, stuff like that. And then Cross Country Mortgage, a big national lender that everybody's probably heard of that listens to this, they saw what I was doing and they were like, we really like that. Can you come do that and help our lenders connect with financial advisors and realtors and give this kind of content out? And I thought that sounds perfect because I'm not really personally passionate about doing the work for a loan. I mean, I'm not lazy, but that's something, it's complicated, and there are people that are really good at it, and I don't really need to take their market share. Like, I don't want, if somebody's going to get a loan anyways, I don't really care whether they get it from me or somebody else. I wasn't really passionate about doing the loan. I just needed to make money. But now what I do is I work at Cross Country and I help create these kinds of things for lenders to help realtors and to build relationships with financial advisors so that they can share these things with people. I found it really difficult to talk about how real estate impacts your finances from the financial side of the business, because there's lots of restrictions and compliance where I couldn't talk freely about those things. But if I brought that experience with me over to the real estate world, now I can talk about these things freely because I sold my practice, I let my licenses go, and now I can say, here's what you need to account for when you're talking about these choices. So things like home ownership, I'm big on, real estate investing, how to balance that with other financial goals that you're trying to accomplish. Reverse mortgages is a topic that I'm very passionate about because I think it's the most misunderstood financial tool on the planet. It's actually, for the financial geeks out there, it's elegant and gorgeous. It's just being mischaracterized and maligned. People don't understand what it is, but it's beautiful.
No, I totally agree with you. It's a great way to take accumulated wealth and redeploy it in a way that allows for additional income, for all kinds of cool things. I mean, for me, it's always fun watching the light go on, Brady. When you get people, especially agents or investors, away from cap rate and cash on cash as being the only way to define the investment, and you start to bring in that time component, the differential cash flow, where you're looking at the additional benefits of the rent growth and appreciation with time, and then comparing that side by side with the debt, where you see a 6 cap where you're going to pay 8% on the 8% interest. That's negative cash flow. How could that be a good deal? Yeah, but I'm only putting in 20% of the money, and I'm making 80%. I'm making 100% of the appreciation on the asset, and 100% of the rent growth belongs to me as well. And so that 6 to 8 ratio all of a sudden is a 9% total annualized return versus a 13% annualized return with debt. And, people just don't. It's amazing how people don't understand the idea of time being a key component to calculating the value of real estate, right? Because it's not the kind of asset that anybody owns buys at breakfast and sells at lunch. You don't day trade real estate. You're going to hold it for a length of time. So as soon as you do that, now I have to calculate the value of time, what time does to the investment, in order to show somebody what I think my job as an agent usually is. Hey, if you're going to make this deployment of capital, this is what you could expect. This is what you're buying, right? When you buy real estate, you buy the future, right? What is the future of this thing? Because I'm married to it. From this, when I close, I'm married to this thing until I give it to somebody else. So what is that period of time?
Is that what marriage means? I forgot. I'm just kidding.
With real estate, yes.
Okay.
Sometimes in other areas that could be a thing too.
Yeah, sure.
So, Brady, I got to ask this, and it's one of the big things. We're talking to entrepreneurs on here, not just real estate people. And I like to talk about your business journey as we go. I've already asked you what the best part of it is, but I like to get into the messy stuff too. What would you say is the toughest part of what you do?
I'd say the toughest part is the negative stigma so I do a lot with reverse mortgages, frankly. We could talk about a few different components there, but there's a negative stigma out there, and it mostly comes from people not understanding the tool itself and not understanding how debt can be a useful tool. So that is the biggest challenge, but I also grapple with that. Sort of like, I think of I have a son who's a wrestler, and it's difficult to wrestle, but it's also the reason that he's there. Yeah. Right. It's also a fun challenge. So I really enjoy that. I do a ton of CE classes for financial planners and accountants and real estate agents. And I show them not just how the tool works, but like, think about this in a financial planning context. Look what this allows you to do. Look what it frees up here. Look what it enables somebody to do that you're trying to help. And not just what it enables them to do, but how it affects the overall financial picture. Like, there are so many aha moments. So it's simultaneously the hardest part, but also the most rewarding part, because as soon as they get that, they're like, oh, I never realized it worked that way. That's amazing. I know like 5 people that need what you're talking about right now. So it's rewarding and challenging at the same time.
Absolutely. And I do want to talk more about the reverse mortgages, but I do also want to take and kind of get that assessment a little bit. As a CEO of yourself, as the person that's in charge of your life, and having to worked as having your own company, and now working for the people that you do, I'm sure there's a lot of stuff that you're responsible to get you to do. What in your makeup do you think makes you good at what you do? If you were going to do the outside of talent assessment of yourself, what in you makes you good at what you do?
I'd say one of the things that I've learned that just seems to come easier to me than others, and I don't know that it's because I'm particularly gifted. I just think about it a lot. So it's a skill that I've developed, is taking complex things and making them understandable to people who don't live in that world.
Yeah.
So I create a lot of visualizations of the concepts I'm trying to create, and I show them in a visual way. And I get compliments all the time where maybe I'm doing a CE class for realtors, and they'll say something like, "That's the fourth CE class that I've attended about reverse mortgages," and now I finally get it.
I
Like that was.
finally get it. I finally got some ROI on continuing to try to do this.
Yeah, and it's because I think one of the reasons I do that is because I think about it. I mean, I might
Yeah.
be in the shower washing my hair, and I'm thinking, how do I explain this concept with images? And then I'll be like, oh, and while my hair is still wet, I'm on my computer taking notes. Like that's the way that it will connect, I think. And then I try it, and I also have the ability, because I do a lot of them. I see what sticks and what doesn't, and sometimes I'm wrong about what will get the light bulb to turn on,
Yeah.
and I'll have to readjust. Like that didn't really hit the way I thought it would. So it's a
Listen,
matter of trial and error. And I have the luxury of doing so many presentations that I get that opportunity to see. But yeah, that's where I think it makes it a little different.
yeah,
And
no,
I have a financial background, which not a lot of people in real estate do.
that is a great combination, and it's really, I mean, when you think about it, real estate is a competitive product to all the stuff that you sold in the past, whether it's equities or whatever. It is a competitive allocation of capital to try to do largely the same thing. How do I make this money work as well as it can be? The thing is, the level of training that you had on the one side versus what they give real estate agents on the other side, there's a vast gulf of difference. You have to understand your product on the equity side to sell it well, or just be an incredible salesman. On real estate, you want to embarrass a real estate agent, Brady? Best question to ask him. So, what's good about real estate? And watch him squirm. It is the most poorly understood product by the people that try to go out and sell. They try to trade on their personality rather than on the strength of their product. And it breaks my heart because our product is so stinking good in real estate. It's such a great product. But the people
Yeah.
that actually sell it don't really understand it.
And I have some sympathy for that, right? It's not easy to be a real estate agent or a lender. Like there's things they have to know that are more complicated. In fact, this is a good example. I was in a financial planner's office once doing a CE class about reverse mortgages, and they kind of joked about realtors being overpaid. Like, oh, all they have to do is go with a key and open the door. And I sort of challenged them on that. I'm like, hang on a second. Like all you do is paperwork for a client. Like if you're only talking about
Paperwork
what
for the guy that
somebody.
brought in the door.
Yeah, and like so you just write with a pen and all of a sudden you get paid 30 grand for some thing that you sold or whatever. Like that's a dumb thing to say. Like it's up here that's valuable. If you actually just got paid for the physical thing that you do for a client, then you probably are overpaid. But the thing that you're doing for someone is like real estate is the thing is real, but how we account for that legally, it's all made up, right? There's plats, there's records at the the counties, and there's all that stuff is made up by humans and it's protected by law. It's a complicated issue, and there's legal things that they abound. And everybody who's gotten a real estate license knows so many things can go wrong that it's important to have somebody licensed doing that, and it's important for them to be good at what they do. But they're not. It's funny. Well, I guess the point that I'm trying to make is back to your earlier comment, which is a lot of them don't understand the financial component, and I have some sympathy for that because there's lots of other things they have to understand, and lots of financial people don't understand the real estate world because they're two careers for good reason, because they're both. It's enough to be a career.
Sure,
Yeah.
absolutely, absolutely. No, that makes sense. And I mean, I think that my position is there's a point where you know what you're doing well enough that is the obvious place. That's the next step that you should take to understand your product well. And
I
um,
completely agree. Like it would be better if more people did.
right, and there's not that's not baked into the environment, that whatever you want to call it, the culture of real estate. Like, oh, you know how to advertise, you're good, you're good, you have what you need. Um, One of the other things that's a big thing in real estate that they don't tell you, this is like not on the brochures. I don't know if you knew about this, Brady, but they always make it seem like, yeah, you go in here, you show some houses, you make a bunch of money. And it's not like that. This business is a lot harder than people think it is from the outside. It's like watching somebody drive Formula One cars. They're going around a track. How hard could it be? It's harder than it looks. I
Yeah.
do that all the time. I might
Yeah.
think about
Yeah.
how hard could it, but then when you go to do it, gee, it is a lot harder than we thought. And one of the things that as entrepreneurs that we've dealt with, and I know you've dealt with this, we all have, is disappointment and unmet expectations. The big closing is supposed to happen and the deal falls apart and the customer's mad at you even though it's not your fault. The big contract is coming in and it doesn't. You have this tremendous opportunity and they pick the other person. How do you manage yourself, Brady, to keep you in the game, swinging away?
I I don't know how applicable this will be to everybody listening, but there was a shift that happened in me probably 6 or 7 years ago. So when I was a younger, adult, when I was just getting started in my career in finance, I chose finance because it was something that I kind of gravitated to, but the goal was earning money and providing for my family. And I don't think there's anything wrong with that. That's a noble thing for someone to do for their family. And so my goal was the money. And I don't mean that in a selfish or greedy way, but I needed money to provide for my family. That was the goal. And the career, what I was doing for people was the instrument that served that goal.
That, yeah.
Yep. It was the career was instrumental to the money. And then something shifted in me 6 years ago. And I don't know if somebody could do this just by trying to do it. It just happened to me where those things sort of shifted for me. And all of a sudden I felt like I had this calling because I had a background in finance. I have a passion and a skill at explaining things that matter to people, that change their lives in a way that they have these aha moments, especially in finance, where a lot of times our intuitions mislead us. That's really common in finance. Math can mislead you, which is why financial advisors exist, right? If all the correct financial decisions were intuitive, nobody would need advice. But they're not intuitive. And I felt like I had a skill at that. I got really good at that while I was doing that career. And all of a sudden those things shifted. And my goal became, I have something that can help people. I can improve people's lives. And in some cases, it's improving a good life to a little bit better life. And in some cases, I can show somebody how, hey, by doing this, you don't have to split your prescription pills in half. You don't have to skip a meal every day. You don't have to eat just peanut butter sandwiches and hot dogs. Like I come across that too. So in some cases, we are literally helping people avoid destitution and live with dignity for the last 20 years of your life. So that became the passion. That's what gets me up in the morning. I love that stuff. And when I'm creating content, I'm thinking, how can I help people understand this so that they can improve their lives? And the money then became second place, and it became the instrument. So as soon as I had that passion and I was chasing it, it became like, okay, I need to figure out how to make money so that I can keep doing this. Because if I can't keep doing this, then I can't help those people, and I got to go get a job somewhere else doing something for the money. And so it became those things switched positions for me, and all of a sudden the money became the instrument, and the goal became how I was going to live my life and what I was going to do with my time here on this earth. And that gave me like this endless spring of energy and passion for what I do. And when I get rejected, I don't feel angry or bitter. I feel kind of sad. Like, what did I do wrong? Like that person needs help and they're not seeing something. How can I do better? Because I want to help more people. And that changed everything. And it wasn't something I wish I could say that I intentionally had this enlightening of some kind and I changed how I think about it. It just sort of happened and I noticed it happened. I didn't make it happen. It just happened. So I don't know how.
I think you found what you were supposed to be doing.
That's important.
That's really like, we struggle around in the dark a lot of times trying to figure out where we're supposed to be. And, for some people, it takes a lot longer than others. My brother's one of those guys, figured it out right away. Like he was on a mission from like day one. Me, it took a little bit longer to figure out where I was supposed to be. But when you're doing what you're supposed to be doing, man, it is a lot easier to get up and do it every single day. I really want to get to this because I know it's kind of been, we've been dancing around it a little bit. I know you have a book that you wrote on reverse mortgages. And I want to talk to you about, maybe get your highlights of why should the folks on here get that book or get in front of somebody to understand reverse mortgages. But tell us why this has you so excited.
There was a book by a guy by the name of Wade Pfau. He's one of the thought leaders in the financial planning space, and somebody recommended that I read that book. And I had heard that reverse mortgages weren't what people thought, and I was like, oh, okay, I should probably learn about that. That's kind of interesting, and I've got a natural curiosity for that sort of thing. And I read it, and it blew me away. The book is really dense financially. It's written for a financial professional, so it's not super it's not well distributed among the general public, but it was a really great book. And that really got me starting down the rabbit hole with that topic. And just high level concepts. A, it's not what people think. B, people have the biggest challenge that that reverse mortgages face is that there's an emotional component to it that is misleading. So the example that I use all the time is if you were going to go on some $50,000 vacation, imagine it's like a 50th wedding anniversary for a couple who wants to celebrate it with their kids and their family, and they want to go on cruise and they want to pay for the whole thing. Let's say they spend 50 grand. Now, as long as that's affordable in the larger financial context, I can't think of anybody who could realistically blame them for doing that, right? It's an expensive vacation, but for a 50th wedding anniversary with the kids and grandkids, like, great. And if they have the money, awesome. And so most people would think, well, if I'm going to pay for that with my investment portfolio, which is fine, by the way, like there's nothing unethical about that. So they pull out 50 grand and they pay for the trip. Nobody regrets that. They've got these little Shutterfly books on their coffee tables, and they never think about that being a waste of money. And I wouldn't either, by the way. But 10 years later, it's unarguable that they are less wealthy by probably around $100,000. If that money would have remained invested, and if it would have doubled over 10 years, which is a little around 7% return, they would have $100,000. So that vacation cost them $50,000 when they took it, and it cost them $100,000 10 years later. And by the way, that concept about money is true about large amounts and small amounts. It doesn't have to be just a vacation, right? If I spend $30 on lunch today, that's $60 I won't have 10 years in the future if I would have invested it. Money always works that way. But when people, and this isn't an argument for them not taking the trip. It's just saying we as humans always have to balance those things, the present value and the future value of what we want to do.
So what you're describing is opportunity cost, the lost opportunity.
Yes, and that's a real thing, right? It's easy for people to spend money that way because they don't have to stare it in the face, right? Your whatever brokerage account you took that money from to go on that trip doesn't show up with a statement every month or every quarter saying, hey, remember that trip you took this many years ago? Do you realize your account really would be this big had you, like, people would probably be a little more careful about spending their money if the statements actually said that. But there's nothing like that. So it's easy for them to just think, oh, that was a fun vacation. I'm glad we did it. And the money's out of sight, out of mind. Now, if somebody would have used a debt instrument, so this isn't true about just reverse mortgages. It's true about debt instruments all the way and or all the time. And by the way, wealthy families and businesses have been doing this for hundreds of years. If I borrow against the asset instead of selling the asset, my balance sheet doesn't care. So if I borrowed 50 grand instead of selling 50 grand, then I still have the $50,000 invested and all of its future growth belongs to me. But this $50,000 loan that I took, now what is unique about a reverse mortgage is that you don't have to make payments if you don't want to. You certainly can, but you don't have to. So I could borrow that $50,000 and never make a payment, and I could just let the interest accrue on the balance. And that's uncomfortable for people. It's not wrong mathematically. It's just emotionally uncomfortable. Yes. Because 10 years later, you look at the statement, because they do account for it, right? Differently from what we were talking about earlier, where your brokerage account doesn't account for the money you took out and spent, but a loan does. Now, it's the same thing mathematically, but it hurts to look at it. Yeah. So if I look at this statement 10 years later and I see that I owe $100,000 for a trip that I took 10 years ago that cost me $50,000, that makes me uncomfortable. But it's very obvious that if you look at the whole picture, my balance sheet is the same way. Either I have a bigger portfolio by $100,000 because I left the 50 invested and I owe 100, or I just don't have the money in my portfolio because I spent that instead. So another way to think of it is like the opportunity cost you're talking about, the lost opportunity of the growth of the asset that I sold is fundamentally the same thing as the interest cost on the loan. As long as I kept the asset instead. Now, if I would have spent both, then I've spent more money. But as far as just spending the $50,000, my balance sheet doesn't care where I got the money from. And businesses and wealthy families, and I'm not talking like 5 million, I'm talking like 50, 100 million plus families who have dedicated financial people managing their assets. They've understood this for 100 years, and they like it for two reasons. First of all, there's no taxable event when I borrow the money. So I can get access for that $50,000, and there's nothing taxable has happened. I didn't sell anything to get it. Another reason they like it is because in a lot of cases, wealthy families' assets aren't liquid to them, which is like home equity for people, by the way. If you want $50,000 of your home equity, you cannot sell $50,000 worth of your house. You either sell all of it or you don't. And if you want to stay there, you don't want to sell it. But you can access that wealth by borrowing against it, and your balance sheet is the same either way as if you could sell $50,000 worth of it.
Correct.
And that's the concept. Sorry, go ahead.
No, it gives you access to capital that is otherwise unavailable.
Yes.
And that's really what it is that we want. We want use of the money. And the idea, it really is a very much an emotional, this idea has been sold so well to Americans that being in debt is being strangled. But I think this is maybe a reflection of what is the normal debt that most Americans experience, which is credit card and student loan type debt, which both are kind of the boot on the throat kind of stuff, where
absolutely
you're on the hook for this stuff. But when you have debt on appreciating assets, especially appreciating assets that are throwing off cash flow, they're largely extricating you from that. and building wealth behind the scenes in that tax deferred growth that is appreciation. So all of those things gear you up to actually making the wisest choice to create the liquidity rather than creating an income event which causes a tax situation. You're not taxed on this because you're not income. You pay tax on income. A loan's not income. A loan you got to pay back. And so, I love what you're saying, man. So who's this the right fit for?
This is going to sound a little bit, I don't know, grandiose, but I'm getting one the day I turn 62.
Yep.
Like my home equity is not liquid to me. If I have a choice between having my wealth liquid or illiquid, I want liquid. All things equal, I want liquidity. And some people might think, well, yeah, but if you borrow against your house, you'll pass on less equity to your heirs. And I say, yeah, but if that keeps me from spending my brokerage account, they're going to get more money there instead. It's the same thing. In fact, if I was going to inherit some money, I would much rather inherit a brokerage account than a home that has to be sold before I can pocket that money.
Absolutely.
I'm going to get the step up in basis for all the financial geeks listening. I'm going to get the step up in basis either way on the brokerage account or the real estate. I would rather inherit the money in something liquid. So borrowing against the house, again, I'm going to do it the day I turn 62 because I don't want any of my wealth that doesn't have to be illiquid. Let me say that correctly. I don't want any of my wealth that can be liquid to be illiquid. That doesn't make any sense. Absolutely. In fact, and some people might think, well, I don't want to spend my equity. And I'm like, great, but that doesn't mean that it shouldn't be liquid. Right. Like, could you imagine? I don't want to spend my savings account either. I have it there in case I need to, but I don't want to spend it. But if I went to the bank and I said, hey, I need my savings because we need to do something at the house, something broke, or I need whatever, right? Some medical bill. I want my savings. If they were to say to me, well, sorry, you can't, that's illiquid, I'd be furious. I may not want it. I want it to be liquid. All things equal, it should be liquid. And that's all you're doing. It's a line of credit. Most people don't understand that. A reverse mortgage is a line of credit. Yeah. And it has really interesting features to it. I mean, the details we can talk about some other time, but it's this concept that I think is creating this mental block for most Americans. They're like, why would I take on debt in my retirement? It's like, that's not what you're doing. I can't imagine anybody, let's say you had a house that was worth $1 million, but you owed $300,000 on it. Are you sitting up tossing and turning every night that you're $300,000 in debt? No, but you are technically. But you have $700,000 of wealth, and that debt helped you acquire it. Like, that's a good thing. I think of, debt's like fire. Everybody's really aware of the destructive capabilities of fire. And if you let it get out of control and you don't respect it, it can destroy like fire.
Yeah.
But also, just about everything you use in modern life is impossible without fire. I can't even get hot water out of my tap without fire. Right. Like, it also has creative characteristics that help us build buildings and cars and hot water. I love hot water. I don't want to go without that. And that's impossible without fire. And so debt is like that. Debt can be destructive. But if you think about the trillions and trillions of dollars that people have in home equity, almost all of that would be would not be in existence without somebody using debt along the way to get that thing going. Now, a lot of people own real estate debt free, but most people, in order to get to that position, they use debt somewhere along the way. So how can you deny its creative? It creates wealth if it's used properly.
Debt-free real estate irritates me as well. I mean, you don't realize what a convert to borrowing money you have on your, like, even the idea on your primary. Why would you not have a line of credit, a home equity line of credit, rather than having a bunch of money in a savings account where that money is being constantly eroded by inflation? I mean, if I have a home equity line of credit and I don't use it, it's just sitting there. That can be my safety net. Instead of having money, I could take the money then theoretically and use more of it in a brokerage account or put it someplace else where I can get some return rather than getting a return from the bank that I know is always insufficient to cover the devaluation of money. I'm basically buying an insurance policy that ensures that I'll have liquid capital. But the knock with the insurance policy is that what they pay me, the difference between what they pay me and what the value of the money loses, is the premium that I'm paying for having that access to liquidity.
It's worse than that, Josh. Like, it's like what you're saying is absolutely correct. But what's worse than that is the opportunity cost of where it should be instead. That's what you're paying to have a bunch of cash in the bank. I mean, you're saying that thing, but like, it's expensive to have $50,000 in the bank or $100,000. It's costing you thousands of dollars a year to do that. and millions of dollars over time because you're losing out on all that compounding. Why wouldn't you have your dry powder, the money that you might need, set aside on a line of credit that is collateralized by something that you already own? It's wealthy families and businesses. That's what they do, and there's a reason for that, because their teams are not emotionally connected to the money. They've been trained to not do that, and they know exactly how to use them. But households just have not realized how to utilize lines of credit in a wealth planning strategy, because Kiplinger's magazine and Money Magazine doesn't talk about it.
Yeah, no. When I teach that, I always say, guys, if I have money in the savings account, who's eating the inflationary loss? I'm eating the inflationary loss. If I have a line of credit, who eats the inflationary loss? It's not me, because it's not my money. It's the bank's money that's sitting there. Okay, yeah, theoretically the line of credit buys less, but who cares? It's not my money, right? That's sitting there. My money is elsewhere earning a return. And so it's such an important concept. Time value of money needs to be taught at some point for these poor kids who are coming.
Yeah, don't get me started on that.
Yeah, no, I'm working on it. I'm actually working on that's the project I'm working on right now, is a curriculum on financial planning for.
Well, if you want some collaboration, I would love to contribute to that.
That is my passion right now, brother. I am, and yeah, maybe it's a conversation we need to have.
Well, another thing that you mentioned, so sorry, you said something that sparked my attention real quick, is another thing that people don't realize is a line of credit of any kind also just gives you an option. Like, nobody's forcing you to use that. So let's say you have this line of credit at the bank set up, or a HECM, because that's what a reverse mortgage is. It's like a HELOC on steroids. It has some interesting features there. But let's say you just have it set up, but you have a very small or a zero balance on it. It's not costing you anything. And if you come across something where you need money, you might be in a position where you've been thinking about selling some asset anyways, because it's sort of run its course and you want to get rid of it, and you don't care about the taxes because you don't want to own that asset anymore, or whatever. You don't have to use the line of credit, but if you don't have it there, you don't have that option.
Absolutely. And it gives you time flexibility, which is so important. I'm going to sell the condo, this investment property over here. Well, with real estate, it's illiquid. Those more liquid asset types, the more liquid capital you have, the more you can take advantage of finding the opportunity in the market when it's the best time to sell. Having that perfect moment of, it's the perfect time to sell, and here's a buyer at the same time I need the money. What the hell are the odds of that?
Yeah, like zero.
It bridges the gap between. It's basically like your bridge financing that you have for yourself. It's a bridge loan to get you between where you want to sell, liquidate other assets, or, well, how do I want to take and structure this? Can I take it out of my 401k without a penalty? It's like, it lets you have the benefit of time. And I think that there's so much power to that, because a lot of times it's inopportune to liquidate when you have to liquidate, rather than when you'd like to liquidate. That makes sense.
Yeah. Or you might not want to liquidate at all. Maybe you don't have investments that you want to sell. And I can imagine some financial people saying, well, yeah, but if I sell money out of my Roth, then I don't have to pay taxes. And that makes me go like, well, if you can take money from anywhere else, take it from, like, leave your Roth alone. That's the best account you have. Don't take it from there if you have any other options. Or they might say, well, I don't have to pay taxes if I'm selling assets for a loss. And I would have the same reaction. Why would you sell assets at a loss unless you really don't want to own them anymore? And there's legitimate argument for that, depending on the scenario. But there's either way, like the line of credit gives you options that you don't have without it. And why would you not want options? You don't have to use them, but options are a luxury, and you can just put that in your back pocket for a rainy day.
Options give you better ways to find ways to do the exact same thing you want to do with better net results. Why would you not want them? I totally agree with that. That's a great way to say it. What would you say, Brady, top 3, top 5, whatever you give me, your number, are the most misunderstood parts of this reverse mortgage thing?
So a lot of people think the bank owns your home when you have a reverse. That's a weird myth that's very stubborn, that has never been true. That isn't how they work. It's a line of credit. And if you sold the house with a balance on that line of credit, of course you'd have to pay that. But that doesn't mean the bank owns your home. It's just that's the amount you borrowed. So that's the weirdest myth. I don't even understand where that came from. That isn't how it works, and it's never worked that way.
When you have a mortgage, they don't.
Yeah. I mean, it's a mortgage on the house. The next one that is really common is people think that you don't make payments on a reverse mortgage. And the answer is that's just one of the options. Imagine if I said, all right, Josh, I've got a HELOC where you can pay interest only. You'd be like, oh, that's kind of cool. That means my minimum required payment is interest, but I can always pay whatever I want. What if I came to you and said, well, your minimum payment is actually zero. You can just let the interest accrue on the balance if you feel like that's in your best interest. You can pay interest only if you want to. You can pay interest in principal. You can pay the whole thing off, or you can pay nothing. That's really, really popular for realtors, by the way, who qualify. You have to be older to get reverse mortgages, because I can have a mortgage, and if I want to make a payment, let's say I closed 3 deals that month, they just kind of stacked and they happened all in that month. I could pay 5 months worth of mortgages, and let's say I don't have a transaction for another 2 or 3 months. I don't have to make a payment for 2 or 3 months. I can leave it alone. Yes, interest will accrue because that's the way loans and mortgages work, but that's just an option that I have. So people think that that mortgages, the reverse mortgages, always accrue, and that's just one of the options. And it's actually kind of, well, not kind of, it's extremely convenient that you have that choice.
I hear what you're saying. And this is, again, for those listening, when he talks about options, this is exactly what he's saying. You know, you're not, when you don't have options, you get forced down a rail, right? This gives you several switch tracks if you're a trained person that you can change rails on. You can choose to come at this from different directions.
Well, and hopefully real estate agents understand that well, and any kind of entrepreneur. When you don't have options, you're at the mercy of whoever you're negotiating with, whether that's a human or just the scenario, the environment around you. Options are the best tool you can have because it gives you flexibility and nimbleness in a certain situation.
Good stuff.
So those are the first two. The next one that I see quite a bit is that what people don't understand is that the credit limit on a reverse mortgage increases over time. So if I have a $300,000 credit limit today, it's going to be $320,000, $325,000 a year from now. It grows every month. So the amount that the credit limit itself increases for the entire life of the loan. So if I get one of these at 62, that's the minimum age you can get the FHA insured reverse mortgage. I can get one at 62, and that line of credit will start growing, and I could still have it at age 102 or 112. And these lines of credit get massive. They get huge.
Nice. You know, Brady, I love this stuff. This is so awesome. But as I told you at the beginning, we have a time constraint, and we've already, just so you guys know, you're not worried, we've already talked about getting back together again with his brother that helped him write his book. So I'd love it if you would, Brady, hold up your book. I know you have it there.
So I got 2 of them. This one is the one about reverse mortgages. We call it the financial ugly duckling, because people just misunderstand it when they see it. They compare it to something that it isn't. They compare it to another mortgage like a duck. They look at that it costs differently. It costs more than traditional mortgages. We can talk about why that is sometime if you want. But they are different. It's a different species. It's not a duck. You have to assess it on its own merits. So that's the first, or that's one of the books that we wrote about reverse mortgages. And then we wrote one, we call it Real Decisions, and we go through the financial impact of renting and owning and what happens over time. And we include all of the, maintenance, inflation, taxes, insurance, rent increases, depreciation and appreciation, and all those kinds of things. We go through all that stuff just to give something authoritative about the idea of, does home ownership make sense? And unless you're talking about temporary situations, it's a good case for it does make sense. It makes a lot of sense. And we compare it to, if you were to put that money in the market and earn this or that, what would that difference be? We do all of that and show that, unless you strike oil, your money is better off. Like you're better off buying your shelter than renting it, because you need it anyways. You're going to spend millions of dollars either way on shelter. You're much better off owning it.
Unless you're comparing it to mom's basement, it's always going to be better to own than it is to rent. Brady, thank you so much, brother. It was great talking to you. I can't wait to get you and your brother back on the show and finish this up, because I had a whole bunch of questions left that I really did want to ask, but it was just you're too stinking interesting, Brady. I need you to bring it back next time. This is a little bit much, but thank you for being on, brother.
No, I love these conversations. Thanks, Josh.
My pleasure. And I want to thank our listeners, guys. Thanks for hanging out with you. Brady is a great example why there's never a good excuse not to know your shit. Till next time, guys.